we've got Paul here, runs a very interesting shop that also has dividend ETFs in it. So we have interest rates declining, and investing in dividend-paying stocks and ETFs seems to be getting a little bit of interest here. And Paul, you manage the Alps O Shares Quality Dividend ETF. That's OUSA. This is sort of the big cap version of OUSM. You screen, it's the same thing here. You screen for high quality, high dividend yield, low volatility. I look at the biggest holdings here. I see Microsoft, I see Apple, JP Morgan. I see a little tech like Broadcom and Verizon. Tell us what we're looking for here, and under what circumstances would this outperform, for example, the S&P 500?
Well, I do think that in some ways what you just laid out, Bob, in terms of those top holdings looking very similar to what some of the top holdings are in the S&P 500 speaks to what Mike talked about. The S&P 500 by nature is a fairly high quality universe of securities. Just looking at sort of your factor attribution, the nature of leverage is much lower in that large cap universe than it is in the small and mid cap universe. And the profitability profile of the leading companies in the market is also significantly higher. So when you look at OUSA versus the S&P 500, it's going to be overweight healthcare, financials, industrials. It's underweight tech to a certain extent, not dramatically so, but it excludes, importantly, energy, real estate, and materials. Two of the most volatile sectors in the market in the way of energy and materials. And so you're looking for dividends as part of the methodology, but you're looking at dividends that are durable, dividends that have been growing, that are well supported by fundamentals. And the juice from a factor perspective, if you want to call it that, just isn't as dramatic as the juice from a factor perspective in OUSM relative to the Russell 2 or the S&P 6.
Why does it exclude energy, real estate, and materials, Paul?
Well, OUSM does the same, and I try and articulate the energy and materials exclusion this way. So if you think about the high-level story and even the name in OUSA and OUSM, they're both quality portfolios with low volatility mandates. And energy and materials are highly cyclical. The fundamentals of those companies are also highly cyclical. When things are good in the energy sector, when things are good in the material sector, their profitability profiles or net debt to EBITDA might look better in those periods of time. Whereas when things aren't good, when the cycle is in its bottom within energy and materials, you can see a significant deterioration in the fundamentals of those specific sectors. So not only do you have price volatility, but you have fundamental volatility in those sectors, which undermines the sort of high-level stated goal of OUSA and OUSM, which is to provide consistent drawdown avoidance.
So essentially the low volatility component here weeds out materials and energy, essentially. Is that right?
It's actually a rule in the index itself. Those sectors are excluded. And real estate's a different animal. A lot of people allocate to that sector independent of an equity framework.
Okay. Regardless, Mike, this is still a somewhat defensive strategy, right? It seems to me this would tend to outperform during periods of maybe market underperformance. No? I'm trying to figure out what circumstances would this matter.
The quality component is historically been less drawdowns, right? So Paul speaks to that really well. You're going to have less drawdown with cleaner balance sheets. That being said, I wouldn't put it in the cyclical nature of value. It kind of leans towards value. If I'm looking at OUSM right now, it trades about 10%, 15% cheaper on a forward multiple basis relative to the S&P 500. A big part of that is getting that yield. I think it yields closer to 2% on a weighted average basis versus 1.25% for the S&P 500. But I think at the end of the day, OUSA would be a better example of a core strategy where you're a little more defensive core strategy. The same can be said for OUSM, whereas a lot of the dividend strategies in the marketplace, the higher yielding strategies that are yielding 3.5%, 4% on a weighted average basis, those are deep value strategies. They're going to be higher volatile, and they're going to either outperform by a lot or underperform by a lot, just given what dynamic we are in the marketplace. But OUSM, OUSA are a little bit more core in that nature.
So, Paul, you've got another dividend strategy I want to get your thoughts on. It's essentially a spin-off of the Dogs of the Dow strategy. This is the Alps Sector Dividend Dogs ETF. The symbol is SDOG, S-D-O-G. It tracks an equal-weighted index of the 5 highest yielding S&P 500 securities in each sector. What's the idea here? What are we looking to do?
Well, the idea is at the beginning of the year, you just look at which stocks have the highest yield in each sector, and then you equally weight the top 5 stocks in those sectors, excluding real estate once again, as OUSM and OUSA do. And I think this gets to, and this is a nice segue to Mike's point about what dividend strategies are. When you look at just yield-oriented strategies like SDOG, they tend to be cyclical value because you look at the equal weighted sector approach of SDOG, and you end up being underweight technology, you end up being overweight significantly utilities, energy, as well as some of the more defensive sectors like staples. And as a result, you have a very different sector profile that is at the very least defensive, but within those sectors, you have a cyclical value orientation. And I would say this, Bob, and we talked about this a little bit prior, is that in a dividend strategy, because many of them that don't have the same guardrails as SDOG have big weights in utilities, you tend to have a lot of leverage in that portfolio on the balance sheet side. And the leverage factor has been one of those factors in the market that has been punished the most in this rising interest rate environment. So to the extent that you can tie some of these dynamics together, Fed easing, declining interest rates, as maybe a signal that investors are moving back toward dividends, out of money markets, out of fixed income, but also importantly, toward leveraged companies that might be rewarded by a declining interest rate environment, that's the sort of sweet spot that SDOG lives in. And Mike, having been at Alps previously, is very familiar with the strategy, I believe.
Yeah. Well, let's just put up what we own here. I always like to put up the largest holdings. 3M, Truist Financial, Citizens, Bristol Myers Squibb, Altria. It's kind of all over the place, but a large number of these are essentially 2%. As you can see, but that would make sense because there's essentially, what is there, 45 stocks in this, Paul? How many are in here?
50 holdings, all
50,
with an equal weight at rebalance.
Right, there you go. So Mike, same thing here. It seems to me, tend to outperform during periods of underperformance. There seems to be slightly more defensive relative to the rest of the S&P 500, right?
Yeah, I mean, at its core, SDOG is a contrarian strategy, right? And the idea being that you start with the S&P 500 or similar construct, the S&P 500. Those companies that have the highest yield, they're temporarily out of favor. When the market brings their yield back in line, you get that alpha component to the strategy. SDOG is a great segue, as Paul mentioned, when you're talking about factors where when I look at OUSA in our database, it has a quality score and an average yield score. Or an average value score. When I look at SDOG, it has one of the highest value scores in our entire database of large cap ETFs, but it also has one of the lower quality scores, right? So it's a deep value. These companies are highly levered, as Paul mentioned, which is not going to help your quality score, yet they're paying very high yield. And to that extent, from a macro environment, when we're getting a broad market rally, when you're in a cyclical environment, SDOG is going to tend to perform well. I wouldn't call it defensive, though. I don't think it's fair to call the strategy itself. It does overweight some of the defensive sectors because of that equal stock, equal sector component. But it really is a true value-driven strategy where it's going to rip when the market hits that environment, and you're going to get a very nice yield while you wait for that to happen.
Yeah. I wonder, Mike, if you give me your thoughts on dividend investing as a strategy itself, because there is a class of investors that absolutely loves dividends. But there has been a debate in academic circles for years that dividends don't really matter at all. That, for example, distributing a 2% dividend just drops the price of the stock 2% and the shareholder gets the 2% in cash. But that doesn't fundamentally change things. The balance sheet gets reduced by 2%. But some people seem to believe that getting a dividend is free money, but it's not. That would be a great trick. And yet, the dividends have an enduring appeal. Can you sort of explain that to everybody why? I mean, academically, it doesn't really change much at all, but people seem to love it.
Well, man, at its core, so first and foremost, to your first point, yes, dividend, if you look at the clear factors within the ETF universe, the dividend category, dividend factor, is the largest by far, and it's not even close. It is by far and away has the most assets allocated to it. And even over the past 10 years, where by and large the category has significantly underperformed, just like value, flows continue to come into this space. So there is an appetite for yield. I like to think of dividends and when the investors and clients that I talk to that are, using dividends as their core, tend to believe that if it's a large cap, stable company and it pays a dividend, they think of it as a sense of quality. They have the ability to maintain and raise that dividend. It's a quality aspect. We've been in an environment where your largest growth companies, especially your mega cap growth, have outperformed. So it just has not worked in that sense because many of those companies, up until recently, didn't even pay dividends. So to that extent, they wouldn't even be in these indexes.
Right.
But I don't have the crystal ball that explains why dividends are so in vogue, other than, I think people look at it as if you're paying a dividend and you have for years, there is a sense to viability to that company's balance sheet.
Right. But Paul, I'll give you the last word on this. I think the answer is people just like getting cash. And if you intellectually explain to them, you're not getting free money here. The company's value is being reduced by, 2% per share if you're getting a 2% dividend. But people like that. The academics will say, well, if you like getting 2% back, why don't you just sell 2% of your shares? It essentially would be the same thing. And yet there's an appeal. I think it's a behavioral economics thing, Paul. What's your thought? People just like getting money.
Yeah, and you're a student of the markets, Bob, and so you know that historically a large portion of your total return profile in the stock market has come from compounded dividends over time. That has been an important driver of returns. But recently, to Mike's point, price return has dominated a lot of that total return profile of the market. And it also speaks to this idea that not all dividend strategies are created equal. First of all, dividend yield can go down in a couple ways. You can either see the stock go up and the dividends stay the same, yield will go down, all else equal, or they can cut their dividend. And so simply focusing on yield can be a fruitful strategy in the right context, but that's why you have strategies like, say, OUSA or others that focus on either dividend growth or the leverage profile, the profitability profile, the quality, if you will, of the dividends that are being provided by a company. So I don't think, because we've had this period of sort of abnormal, if you want to call it that, total return profile in the market, that all of a sudden dividends aren't relevant. But I do think you make an important point, Bob, that there are trade-offs from a capital exercise perspective that companies make when deciding to either issue a dividend, support a dividend, grow a dividend, because ultimately they're sacrificing or trading off other things they can do with that capital.
Right. Yeah, we can go round and round on this. I've been fascinated by this for years, but if your goal here is the wonders of compounding interest, taking that 2% dividend out and consuming it takes you out of the market by 2%. You want to obviously reinvest the dividend, but a lot of people don't actually do that. So my point is that from a behavioral economics perspective, you can explain to people that doesn't make a lot of sense, but people like taking the dividend and somehow consuming it. I love talking about this subject.